Last night, I listened to the All In podcast with Scott Bessent, U.S. Treasury Secretary, and I walked away with some interesting thoughts on the future of the economy, asset prices, and Bitcoin. To recap how Bessent and the Trump administration are thinking about economic strategy, their primary focus is cutting government spending, not by completely shutting down government or making drastic cuts overnight, but by making it more efficient and gradually reducing spending over the next 4 years. Their goal is to make government spending a lower percentage of GDP while simultaneously lowering interest rates. Lower interest rates accomplish two things. First, they help mitigate the issue of high government spending by reducing the federal interest expense, which has become a significant portion of the budget, over $1 trillion annually. Second, they enable the administration's broader strategy of deleveraging the federal government while re-leveraging the private sector. Cutting government spending frees up more capital for the private sector, and lower interest rates encourage businesses and individuals to borrow and invest in private sector projects. Some have interpreted this strategy as an attempt to crash the market, but in my opinion, that seems unlikely. While overheated markets may experience corrections, I think the administration's incentive is to keep markets near all-time highs. A strong market fosters optimism, encouraging borrowing and investment, which is how the dollar-based banking system operates. Credit expansion fuels economic growth, and if asset prices were to collapse, businesses would hesitate to borrow and invest. Balancing spending cuts with a pro-growth environment is a challenge, which suggests that the government will continue running significant deficits rather than making deep cuts. The administration's real focus is on efficiency, reducing wasteful spending, lowering interest costs, and fostering a more business-friendly regulatory environment. In addition to spending reforms, the administration aims to cut regulations in banking and energy. Deregulation makes private investment more appealing, while lower energy costs reduce input expenses across nearly every industry, increasing profitability and making projects more attractive. Easing banking regulations will also make credit more accessible, particularly for small and medium-sized businesses, further incentivizing borrowing and economic expansion. This shift toward re-leveraging the private sector has major implications for Bitcoin. The repeal of SAB 121, which previously restricted banks from holding Bitcoin on their balance sheets, could lead to a significant increase in Bitcoin-based lending services. As M2 money supply expands with rising private sector borrowing, a growing portion of that liquidity could flow into Bitcoin. With stocks and real estate already at high valuations, Bitcoin stands out as a high return asset that would attract capital in this environment. All of this creates a near perfect storm where liquidity growth fuels private investment, and Bitcoin is positioned as one of the best places to allocate capital. While stocks and real estate may see moderate gains over the next 4 years, Bitcoin could experience a parabolic bull market as institutional adoption accelerates and capital increasingly flows toward it. The all-in discussion with Scott Bessent reinforced my optimism for both America and Bitcoin, as the macroeconomic trends suggest that liquidity will continue expanding, interest rates will come down, and private sector investment will accelerate. Conditions that are highly favorable for a Bitcoin parabolic bull run. Thanks for watching, everyone, and see you next time.